Hello and welcome. Today, we will talk about the importance of patience and discipline when investing. Success does not come overnight, but with clear goals and consistent effort, you can build a future that brings stability and freedom. Did you know that making money in the stock market is not that difficult? But more than 80% of new investors lose money in the market. Not because the market is unfair, but because they do it wrong, with the wrong goals. Or because they never even asked themselves why they were investing. Some enter looking for quick money. Others follow a friend's advice. Many copy what they see on the internet. The result? Frustration, losses, and giving up. But we are not here to repeat that story. Our goal is to be among the winners. And it all starts with the essentials. Your mindset, your relationship with money, and the clarity of your goals. Because investing does not begin on a broker's screen, it begins in your mind. If you clearly define why you invest and with what horizon, you will already have more than half the battle won. Investing requires patience, but also taking advantage of the right moment. Today you have that opportunity. You may think this is more of the same. It is not. What you are about to hear is designed to make winning more likely than losing. But pay attention. It is not a short or easy path. It requires work, patience, and discipline. So join me in this chapter. We will talk about mindset and goals in stock market investing. Because building an investment is like building a house. You need wisdom and solid foundations. Imagine two people, one builds on solid rock and the other on sand. When the rains and winds come, the first one stands, but the second collapses. It is the same with the stock market. If you build your strategy on emotions, rumors, or impulses, sooner or later it will fall apart. But if you ground it in clear goals, with discipline and patience, you will be able to withstand any market storm. The first thing we will look at is mindset and goals in investing. Investing in the stock market does not begin with opening a broker account or choosing a stock. It starts much earlier, with the mindset you bring and the goals you set. This first part is fundamental because it determines not only what you will do with your money, but also how you will react when the market moves. And believe me, the market always moves. I will divide this block into 4 main sections. First, the importance of the right mindset. Second, defining the why of your investment. Third, setting realistic and achievable goals. Fourth, connecting goals with timelines, short, medium, and long term. Let me explain the first point, the importance of the right mindset. Investing in the stock market is not a lottery or a casino. It is not about betting that a stock will go up tomorrow. The stock market is, in essence, a mechanism that transfers wealth from the impatient to the patient. Those who stay calm, study, and follow a plan end up building value. Imagine two people who start investing on the same day. Carlos arrives as if he were entering a Las Vegas casino, convinced that in 2 weeks he will retire on the beach. He buys, sells, buys again, follows every internet rumor as if it were divine revelation. The result, instead of doubling his money, the only things he doubled were his dark circles and arguments with his partner. Maria, on the other hand, takes it differently. Before moving a single euro, she asks herself how much she can invest without disrupting her daily life. She chooses companies with solid fundamentals, sets goals for several years, and writes her plan. When the market drops, she doesn't tear her hair out. She already knew that would happen. While Carlos changes brokers every month, she simply waits and watches her money grow. In the end, the difference wasn't the stocks they chose, but the mindset they started with. That is why the first step is to break some myths. You will not get rich overnight. There is no magic shortcut, nor a secret stock that only a few know about. The stock market does not guarantee profits. What it offers is an increasing probability of success when you invest with time, discipline, and knowledge. This is where mindset comes in. If you enter seeking adrenaline and immediate results, you will probably end up losing money. If you enter calmly, thinking of the future, and accepting that there will be ups and downs, your experience will be completely different. Now let's continue with the second point, defining the why of your investment. Before you put a single euro or dollar into the market, ask yourself, why do I want to invest? What do I need this money to give me? What role will investing play in my life? I have a friend who confessed to me that every time he went on vacation with his family, he couldn't enjoy it. He spent all his time thinking about the bill for each hotel, each meal, and although he wanted his children to be happy, his bitter face ruined the whole effort. Year after year, it was the same story. I advised him to skip some expensive vacations and invest that money instead. I built him a portfolio with a very clear objective that, within a few years, the dividends would pay for the family's beach vacations. My friend told me that every time he reinvested, he imagined umbrellas, ice creams, and beach bars. The result? Now every summer he goes on holiday and proudly says that even the waves are paid for by the stock market. The point is, he never lost sight of his why. It wasn't a yacht or a castle in Tuscany. It was something achievable, and that was the key. Here are some typical answers. 1. Extra income. Maybe you want to generate dividends that complement your current salary. This does not mean doubling your income in 6 months, but gradually building a portfolio that pays every quarter or every year. 2. Retirement. One of the most common objectives. The stock market is a very efficient vehicle for building wealth that, in 15, 20, or 30 years, will allow you to live with peace of mind. Here the horizon is long and patience is your greatest ally. 3. Diversification of wealth. Maybe you already have a business, a house, and savings in the bank, but you want to diversify. The stock market allows you to spread risk across different sectors, countries, and types of companies. The important thing is to be honest with yourself. Investing without knowing why you are doing it is like boarding a ship with no destination. You will end up at the mercy of market currents. Next comes the third point, setting realistic and achievable goals. Once you know why you want to invest, it's time to define what you expect to achieve in concrete terms. Your goals may change in the future, and your investments can be restructured if you have the capacity to increase amounts. But start with realistic goals. And if the investments are solid and monitored regularly, they may begin modestly, but will grow little by little over time. And start as soon as possible, like the young man who earns $1,200 and saves $200. The key is that those $200 do not affect your daily life. Otherwise, it will be like trying to run a marathon without ever finishing a lap around the park. Those $200 will grow and accumulate with other $200s, creating financial stability, access to credit, and new opportunities. As the saying goes, money attracts money. Over the years, as the portfolio and experience grow, with your first objectives achieved, only then will you be ready to set new ones. But first of all, work on your goals. Ask yourself questions like, do I want my investment portfolio to generate a monthly amount within 10 years? Do I want to accumulate a certain amount of invested money by age 55? Do I want my savings to avoid losing value against inflation? For a goal to be useful, it must follow the SMART rule. S. Specific, not I want to be rich, but I want to accumulate 100,000 euros invested in 7 years. M. Measurable, you must be able to check whether you are moving closer or not. A. Achievable, dreaming is good, but if you earn 1,000 euros a month, you cannot aim to invest 1,000. R. Realistic, consistent with your means and knowledge. T. Time-bound, give it a deadline. This is where many people fail. They confuse a desire with a goal. And the stock market punishes desires, but rewards plans. The fourth point is connecting goals with timelines. Another common mistake is not understanding the difference between investing short, medium, and long term. An old lady from my neighborhood always said, I plant tomatoes for the summer, but I take care of the olive tree for my grandchildren. I do the same with the stock market. A bit of trading is fine, but enough solid stocks for the long term. Today her grandchildren enjoy the olives, and I learned a great lesson. Every time someone asks me why I don't panic when the market falls, I answer, do you rip out an olive tree because one summer it didn't give many olives? Neither do I rip out my investments. The secret is to give them time and a little care. Short term, less than a year. Here you find speculative operations or trading. It requires experience, risk management, and acceptance that you can lose quickly. It is not recommended for a new investor. Medium term, between 1 and 5 years. Objectives like saving for a down payment on a house, a master's degree, or a personal project. Here you must choose less volatile assets because you don't have much time to recover from a market downturn. Long term, more than 5 years, ideally between 10 and 30. This is where the stock market really shines. Here compound interest works its magic, reinvesting dividends and letting stocks grow. History shows that despite crises and downturns, markets tend to rise in the long run. The discipline of an investor lies in accepting that big goals require time. The stock market is not a sprint, it is a marathon. When you set your goals, think about the old lady's olive trees. Some investments only bear fruit after many years. An olive tree can take 7 to 10 years to produce its first olives. After 20 years it reaches full production, and once it starts, it can keep producing for centuries. That is the logic. It requires patience, but the reward is stable and long-lasting. In summary, investing begins in your mind, not in your broker's account. Ask yourself why you are investing: income, retirement, or diversification. Define SMART goals, realistic and measurable. Connect each goal to an appropriate timeline. And most importantly, accept that the stock market is not quick money, it is discipline, patience, and consistency. In the next chapter, we will talk about the market and equities. The information presented here is part of scientific studies on geofinancial analysis. Follow us on our website, TradeGainers.com, the financial geo portal where you will find much more information and real-time analysis. And please don't forget to like this video.